Hi and good morning to everyone. So in today's class, we are going to see about the adjusting entries of final accounts. Okay. So in last two videos, we would have seen about 14 adjustment. So only where those 14 adjustment will be reflected in the trading P&L balance sheet we saw. So we know the rule that adjustment will have a twofold effect, and we completed all those things. Now moving on to adjusting entries. Sometimes for a 2 marks or 5 marks they might ask you the adjusting entries also for 11th standard, even at college levels. So for such purpose we are now moving on to the journal entries of these 14 adjustment, which is very important and for 11th standard students. Okay, so moving on to the first thing, that is closing stock. So while taking the adjusting entries, I'll just revise where the twofold effect of the adjustment will be there in the trading P&L and balance sheet also. So moving on to the first thing, that is closing stock. So adjusting entry la first one today we are going to see is closing stock. So as you know, closing stock will have twofold effect. One in trading side of the trading account credit side, and one more thing in the asset side of the balance sheet. Here the adjusting entry will be closing stock account data to trading account, and you will write the narration being closing stock adjusted. Okay, so this is the adjusting entry. Next thing is outstanding expenses. So for whatever concern expense you have the outstanding, you will add it with the respective expense, and it will go to the liability side. And the journal entry is, since it is a liability side, I will give you one small int. Liability side la usually what it will have a credit balance illa, appo wages outstanding we have to credit into, you just remember. okayla, idha oru chinna int. So wages account data or expense, whatever the concern expense account data to wages outstanding account. See, wages outstanding is credited, so that will be your int. Then prepaid expense, what we will do, we will subtract it with the concerned expense and put it in the asset side. So again the int is asset side na debit balance it will be. So debit balance na enna pannom, debit pannom, that int you will have, and the entry will be prepaid expense account data to respective concerned expense or whatever the being given. Insurance I have taken here, so insurance in short form I have written. Okay, then accrued income. Okay, so accrued income, what we will do, add it with the respective income and put it in asset side. So since it's an asset, you have a debit balance, so start off with debit the accrued income. Accrued income account data to respective income account. Okay, so here I have taken commission received as example. So accrued commission account data to commission received account. Then we have the next thing, income received in advance. So income received in advance, we will subtract it and put it in liability side. So liability side now you have an int, so it will be credited. So respective income account data to income received in account. Okay, so that will be your int. Then moving on to the next thing, that is depreciation. Depreciation, what we will do, depreciation we have to subtract with the respective asset in the balance sheet, and you will take it to the P&L accounts, charge against the profit. Okay, so it is you will write the entry as depreciation account data to respective asset account. Okay, then the next adjustment is interest on capital. So interest on capital, you all know, it will be added with the capital, and you will take it to the debit side of the P&L account. Okay, so you will write interest on capital account data to capital account, because it is the minimum interest which the company, the firm is giving to the owner. Okay, so it will be added along with the capital. So you write interest on capital account data to capital account. There is one more entry also, we call it to be a transfer entry. It is P&L account debtor to interest on capital account, that I have not given. Okay, so we are seeing only one adjusting entry, transfer entry and all I'm not telling you. Okay, then for interest on drawing, it will be subtracted with the capital, so the journal, and it will go to the credit side of the P&L account. So you will write the adjusting entry to be capital account data to interest on drawing account. Okay, so this is the first 8 adjusting entry which we have seen in the first video. Now we will move on to the second set of journal entries which we saw in the second video, that is relating to bad debts, provision, all those stuff. Okay, so for bad debts, we all know bad debts is the amount which would be given to subtract from the sundry debtors in the balance sheet asset side. Okay, so the entry you will pass is bad debts account debtor to debtors account, and you will charge it to P&L account. Okay, then next item is provision for bad and doubtful debts. So provision for bad and doubtful debts, you will write provision for bad and doubtful debts account debtor to bad debts account. Okay, so 2 bad debts you will charge. Okay, you are making a provision against it. And there is one more entry is called as transfer entry, because this thing is specially asked for 11th standard and 12th standard board exam. So there is a one more entry called transfer entry, that is P&L account data to provision for bad and doubtful debts. That I have written in short, PBDD, that is provision for bad and doubtful debts. Okay, so you have to pass 2 journal entries in this case. Okay, next moving on to provision for discount on debtors. So provision for discount on debtors, the journal entry will be P&L account data to provision for discount on debtors, and provision for discount on creditors, you will write the journal entry as provision for discount on creditors to P&L account. Okay, the reverse of this entry. Okay, then this is not mostly asked. Then comes income tax paid, they will give you intentionally. So income tax paid is not an expense to the firm. You have to remember it has to be treated like a drawing. In such case, the journal entry will be drawings account data to bank or cash, and in narration you will mention that being income tax paid. Okay, so income tax paid is not an expense to the firm, it's a personal expenditure of the owner, so it will be treated as a drawing. Okay, so that point alone you just remember. Then comes the most important thing which we would have not seen in the 14 adjustment. Okay, so it is called managerial commission. So managerial commission might be directly given in the sum. So since I have done in the format, it has not been given there. So here I am going to teach you in detail the managerial commission. So managerial commission, 2 types they can give you. 2 types they can ask you in the question paper. They can ask you before charging such commission or after charging such commission. Okay, so before charging such commission அப்படின்ற word இருந்ததுன்னா, it's very simple. Directly net profit you will find out. No, so what you will do, P&L account you will prepare. P&L account you will total all these side, then you will subtract all the expenses and you will find out net profit. So that net profit direct percentage you can apply. Imagine net profit is 50,000 na, direct 5% போட்டு you can find out managerial commission. That is before charging such commission அப்படின்னு we will take. But if they give you the word after charging such commission அப்படின்னா, if they give you, then what implies na, before net profit the manager commission has to be 5% அப்படின்னா இதில் அப்படியே 5% போட்டால் நம்மளுக்கு கிடச்சிடும். பட் ஆஃப்டர் சார்ஜிங் சச் கமிஷன் 5% அப்படின்னா, ஸோ இங்கே வந்து it will be 5 rupees is the commission amount. அப்போது net profit will be 100 rupees in அர்த்தம். But we don't know both the amount, right? We don't know what is the commission and we don't know what is the net profit. So in such case, what we will assume? We will assume 5% on 105 rupees, because it is the total, including commission is what is the net profit, because we don't know what is the commission amount. So you will take it 5 by 105. For example, இப்போ net profit வந்து 50,000 இருந்ததுன்னு வச்சுக்கோங்க, you will charge 5 by 105 and not 5% simply. So if the word after charging is given, you will write net percent profit into rate by 100 plus rate. இப்போ 10% na 10 by 110, like that you will go and find out. The logic is net profit la commission will also be included. So we don't know commission itself. How we know the net profit? So the commission of 5 rupees is being included in the 100 rupees abdin we assume. So only we charge 5 by 105 when they give you the word after charging such commission. So question paper la just read carefully. Manager commission before or after? Before na 5 by 100 போட்டுக்கோங்க, after na 5 by 105 போட்டுக்கோங்க. ஓகேங்களா? Then the journal entry in that case is managerial commission account data to outstanding commission account, liability side போடும். ஸோ என்ன ஆகும், இங்கே நெட் பிஎன்எல் அக்கௌண்ட்டில் கமிஷன் அண்ட் 5 rupees அப்படி வந்துடும், நெட் ப்ராஃபிட் 100 rupees-ஆக இருக்கும். Balance sheet la we have not paid that commission because it is given in adjustment naturally, right? So outstanding balance sheet la outstanding ah irukum. So P&L account la debit side la you will charge, balance sheet la it will go to outstanding liability. Okay, so because this adjustment has not been done in beforehand, I am teaching this in detail. Okay, so with this we have completed all the adjustment relating to final accounts. Okay, hopefully you would have understood all the adjusting entries. Thank you.